What is going on, everybody? Welcome back to Bonafide Investing, Cash Flow Life, where we talk about everything high yield strategies, options, as well as futures, as well as goals in general. If you're new to the channel, welcome. What we do here, I guess the story behind it, long story short, is that I've taken about 20 to 25% of my total net worth. I have put it into what I consider a decent all-weather, high-income portfolio that tries to stay mindful of NAV erosion with high yield, as well as I want to maintain and pay down my margin over time. So if any of that resonates with you, welcome to the channel. Just some updates on the stats. You can see my margin buffer is still around 60%. What I want to do is I want to actually look at the last part of the portfolio, which are your tangible assets, right? Your precious metals like gold, real estate, etc. So gold, I'm a huge fan of gold. I like gold and silver a lot. As a matter of fact, I think gold is one of the first investments I bought over 20 years ago. Glad I did. Gold's done as well as the S&P 500 since the mid-90s, which is a crazy stat. As a matter of fact, it may have passed it. I got to go back and double check that. But gold is tangible. Gold is real. Gold can't be faked, right? And it's, at the end of the day, it's God's money. So it is something that is trusted worldwide. I can take a gold coin into any part in the world, any major city in the world, and get local currency for it. So again, forgot to mention that nothing in this channel is financial advice. Everything is for educational purposes only. So please do your own due diligence before making investment decisions. So gold, huge fan, like I mentioned. I think everybody should own some. And GDXY is the first one we'll look at today. And what I like about GDXY is that it's a miner. I have a very small miner exposure to it. My target allocation is 2%. Gold miners, I'm not always a huge fan. The reason I'm owning a small allocation is that I think they have a lot of catch up to do with the gold run that we've seen. But gold miners have historically been awful investments. I mean, you'll see some years gold's way up and miners are down. And they typically track the indices more than they even track gold at times. So not my favorite. The reason I like YieldMax's gold miner ETF here is that it just pumps out large distributions. And I've got about 620 shares. My total return is higher than that minus 2.02% you see here. Again, Robinhood is not accounting for the distributions I've been paid from this ETF. It holds some of your big names, right? GDX is going to get the bigger names in the space. Then most of your other, GDXJ, which holds a lot of the juniors. This is going to hold a lot of your big ones. Freeport McMoRan, Agnico, Goldfields, miners like that. So I like GDX. It is probably the most stable, GDXY is probably the most stable ETF when it comes to gold miners because it, again, is selling calls on the GDX. So small allocation, I'm dollar cost averaging in $4 per market day. That will hopefully keep me at that 2% portfolio allocation, but I will be rebalancing the entire strategy quarterly. Right now, this has been paying anywhere from, it's been very volatile, been paying anywhere from like a 35 to 65% yield, just depending. This week was lower than the previous week. But I'd say overall, this is paying anywhere from about 40 to 50% on average for an annual yield. The NAV decay, it will come down in NAV, so it will fall more than some of the other ETFs I hold. But it's okay. I'm going to hold this one while gold is having this magnificent bull run. And until that changes, GDXY is where I'm going to just keep a little capital allocated to get that diversification. The next fund I want to look at, the next ETF in the gold space, is GLDY. The GLDY, this is gets direct exposure to GLD, which is just gold itself, right? GLD is an ETF that holds gold. And what Defiance has done here is that they will sell calls on the GLD. And they're selling pretty frequent calls. I want to say daily or weekly calls on the GLD. And this has been generating a lot of income, okay? I mean, this has been paying anywhere from 40 to 60% annualized. The total return you see of minus 1.69% is not, again, accurate. I've got, made thousands of dollars so far off of the distributions alone. I picked 10% for this one because I like the high income upfront, right? Just paying the high income, reinvesting back in $20, per market day. So keeping that portfolio diversity right around 10% for GLDY. I own gold in various forms, various ways. So having a high cash flow machine that GLDY is for gold is really, really enticing. Now, with that said, I'm going to be very mindful of NAV erosion. So you're not going to get a lot of gains with GLDY. When gold goes up, it's going to miss a lot of that upside, but it'll make up for a lot of that upside with premium. Is it a perfect offset one-to-one? Absolutely not. I don't think any ETF or fund really is, but having that high income help pay my bills, help pay down that margin a lot faster. So currently I own 2,990 shares, dollar cost averaging in about $100 per week like we looked at. So this is another one. While gold is having this bull market, I'd like to have about 10% of the portfolio in GLDY. Pays weekly, goes ex-dividend on Thursdays and pays on Fridays. Next one I want to look at is IAUI. I think I've mentioned it in the past. I'm a big fan of NEOS funds. I really like these funds a lot. I think they're doing a great job at NEOS, especially around the NAV component, right? We talk a lot about NAV here and why it's important to keep that NAV intact, not let it just erode over time, because what's the point, right? If you lose all your money to the downside, but you're getting paid, it feels like a wash or worse at the end of the day. So NEOS has been doing a great job, in my opinion, across a lot of their funds. Again, do your due diligence, as I've mentioned before. Don't just go out and mimic this or buy it because someone's a fan of it. But what I like about IAUI is that it pays good, steady monthly income. They are selling calls on IAU and GLD, which are the two biggest gold ETFs in the market currently that just track the price of gold. This is closer to about an 11 to 14% yield. I think that's a healthy yield. I have seen some growth across this position, as well as some good distributions. So I'm up more than the 4.4% shown. It's not accounting for my distributions I've made on this so far. And my goal with IAUI is to keep it right around 5% for the entire portfolio. So again, bringing up my total gold exposure now to about 17%. And you'll see why my total gold allocation, I'm trying to keep it about 22%. Again, I have a huge bias for gold. I'm not a gold bug. I'm not a really anything bug. I don't think anybody should be a bug of anything. It starts to skew, I think, judgment and cause biases that I think hurt people, right? They can't be open-minded and change when they need to. So I'd say though, if I had to be a bug of something, it'd probably be gold, but no, not a gold bug. I just really like it. I think gold, everybody should know gold. Like I said, it's God's money. And I think every portfolio should have some exposure. Percentage-wise, that's really up to the investor. I like to have at least 20% or more in gold, but again, to each their own. Lower maintenance ratio, just like the other positions I've shown you, 25%, not eating into my margin equity. And then $10 per market day goes back into IAUI. Another one of my favorites is IGLD. So IGLD is another gold ETF to generate income on gold. It's got a slightly different way of doing things. I think they involve some puts as well as calls. This is probably the lowest yielding ETF of all of them, and it's had the most stability price-wise, which is no surprise. We talked about this before. Usually lower the yield, the more price stability you're going to get, or more tracking of that index or underlying holding, right? So really been happy with this. They paid a really, really huge distribution late November, early December, and is about 3 to 4 times more than it's been. So that was a nice treat. I own 999 shares of IGLD. 5% allocation is the goal on this one as well. So that brings my total to, like I said, 22% is what I'm targeting. I threw that 2% of GDXY in to go with the 20% that is just tracking the actual price of gold. Total return on this has been great, up about 4.6%. So actually a little bit higher than that because, like I said, this is not accounting for the income generated. Low margin ratio. Always happy to see that. I like to keep my margin ratios 25, 30%. I really won't go over 50%. And there's got to be a good reason to have a maintenance ratio of 50% or higher if I'm going to own it. Dollar cost averaging in $10 per market day into IGLD as well. So again, just having gold pay me, right? Physical gold is important. I think everybody should have physical gold, physical silver, but they're kind of sitting there not paying you at the same time, right? So I think to help pay my bills, generate income off my favorite asset, this is why I use these ETFs to generate income off of the precious metal space. We'll throw in the real estate piece as well. I like IYRI. What I like about it is that it gives me some exposure to quality real estate investment trusts or REITs. Okay. And the goal here, 3% target allocation. So you can see between gold and real estate, I have a total of 25%. These are all hard assets, right? Tangible things that can't be reproduced, like I said. And to quote Warren Buffett, because I know nobody's really ever done that before, right? You buy real estate, they're not making it anymore. So it's true. Now, commercial real estate, I know that's got its own issues, but when it comes to things we need, I don't know, gyms, grocery stores, just certain stores that we rely on, right? Certain malls, day in and day out. I think real estate is important. So I think what NEOS is doing here is they're doing a good job of producing income off of these already sometimes high yielding REITs in the first place. A lot of these names, some of them are probably familiar. I might even sell a put on Realty Income this coming week. So very familiar with Realty Income. Public Storage, they're well known. Will Tower, so Simon Property Group and malls. A lot of names you're familiar with. So they hold quality REITs. There's no penny stocks, no junk in it. So I really like the percentage breakdown and how they're generating even more income off of these, I think, high quality real estate investment trusts. So I'm dollar cost averaging $6 per market day, try to keep around that 3% portfolio diversity the best I can. NEOS pays once a month, which is fine. When you use margin, you like to see those, weekly and monthly distributions. So this is why I like IYRI so much. We'll briefly touch on RDTE. I think it's the odd man out, right? Kind of by itself. We haven't really talked about it. Why I like just a little bit of small cap exposure throughout the portfolio. Lower rates overall, especially on the long end of the curve, like the 10-year treasury, is really good for the small caps because they have a lot of debt. And a lot of these companies are not even profitable typically, right? So you'll have a basket of 2,000 stocks, I don't know, probably 80, 90% of them, if not more, really don't even produce any profit. So a lot of them are still in growth mode, trying to become those mid cap and then eventually, large cap, potentially blue chip stocks later on. So what I like what Round Hill's done, just like an XDTE and QDTE that we've talked about in prior videos, I like that they have an ETF that sells daily calls on the Russell 2000. This is not an ETF I own for any sort of growth. And what's interesting is the Russell is typically a growth index, right? It's seen as growth over income for the reasons I just mentioned. High debt, these companies really don't produce a profit. So there is that growth component. So my thought process was, I really don't mind even owning a 0DTE ETF on the Russell because though I don't count on the growth in this because it's generating high income, roughly 40 to 50% annualized, it should still get a little bit of growth as the Russell grows because the Russell will typically outgrow the S&P and even the NASDAQ, sometimes for good stretches, some good years on end. So that's my thought with this. I'm trying to keep the portfolio about 5% small cap, dollar cost averaging in $10 per market day on RDTE as well. Just want to mention that. I think there's a place for small caps within the portfolio just to, again, get that potential growth that the small cap space can provide. I think if rates do fall, I'm not really in that camp that rates will fall, but if they do fall, that should really help the Round Hill Russell 2000 ETF here. So we'll see. Again, I like the income. The income, again, is for paying my bills and paying down that margin. So this one will stay in the portfolio as of now as well. So now we've been through all of the ETFs, the all-weather portfolio diversification, why I use it. I'll probably be making about 1 to 2 videos per week is the goal. Just with updates on that portfolio, changes I've made. We can talk about some of the issues like around the Fed, interest rates, what have you. We can have conversations there, but love to hear your thoughts. Hit like and subscribe if you like what we're doing here at Bonafide Investing, and have a great day.